All right, guys, in this video, we're talking about how to finance real estate purchases. Most people get hung up here because I don't have enough money to go buy a rental property, or how do I even start? Where can I get the money? And so it can be tricky to get started, and it actually holds up a lot of people, right? As we've discussed, real estate investment trusts, some of these platforms that crowdfund real estate purchases, they have much lower minimums, and you're able to get in for a lower amount of money. But if you're looking to go purchase physical real estate yourself, it can be tricky to know where to start. So this is what we're going to discuss today. Now, one principle we have to understand, I used to hear this all the time when I would research, I looked into real estate investing for myself, is you don't need your own money. You can use other people's money, or OPM. I always thought that was the weirdest thing ever. Like, whose money are we talking about? I don't know anybody that has money. Like, who has this money that I'm going to go get and use to buy real estate? I'm going to answer that here because it's basically everybody uses other people's money to purchase real estate. Basically, everybody uses other people's money just to live, okay? Other people's money is just money that's not yours. Anybody goes to purchase a house, you put down a down payment, and then you get a mortgage. Whose money are you using to buy the house? You're using the bank's money. When you swipe your credit card, whose money are you using? Not yours. You're using the credit card company's money. You're using other people's money. So we use other people's money all the time without even realizing it. And so in real estate, it is no different. Whether you get that money from a bank or some other source, you're going to use other people's money for the bulk of it, okay? If not all of it. So let's talk about some of these methods. Mortgages, all right? You can get a mortgage on an investment property, okay? Typically, you need to put down, I'll just caveat this by saying that it's not just one set rule. There are some that are regulatory, but every lender is going to look at this differently, and they might have different rules for qualifying whether you are approved or not. So I'm just going to put that out there. Some are more friendly to real estate investors than others, and you kind of figure that out as you go through the process or as you talk to people in the space. So for investment properties, though, you're going to need 20% down as a down payment. Okay, that's pretty much across the board. You need at least 20% down. You are going to have higher interest rates on that mortgage. Okay, you don't get the preferential rates that you might get when you purchase a primary residence for yourself. Under your own name, you can have up to 10 mortgages. It used to be 4. Fannie Mae increased it to 10. So you can have up to 10 mortgages in your own name, which is quite a few properties under your own name that you have a mortgage on. So yeah, 10 mortgages maximum per person. Some lenders will not do that many. They might not approve you. Some will go up to 10. Okay, so you just got to check on that. As far as being qualified based on income, you generally speaking need enough income to qualify for that mortgage, for that investment property. Some lenders are strict and they won't look at future rental income as income for you because it's just not, it doesn't exist yet, okay? Some don't, okay? If they're very conservative, they won't look at that. But a lot of lenders will actually factor that in. And what they would do is they would look at market rents. They would take an average kind of market rents. They would do some research, ask an appraiser and all that type of thing. And then they would get the net monthly rate. So after, if you're approved for the mortgage, what your costs would be and what the other costs are. So they'd find your net cash flow. And then they would take 75% of that. Then they would count that as rental income. The 25% accounts for vacancies that you might have or big repairs or things like that. So they can go up to 75% of the net rental income that you'd receive, you're projected to receive, and count that as income in order to qualify for the mortgage. If you have other rental properties and you're receiving rental income from those, generally you need a decent track record of income from those. 1 year or 2 years of solid track record with rental history. If not, some don't like that. They don't want a short track record, in other words. They want to see that this is sustainable as far as rents go, but they could also apply the same rule as with the future projected income of your, the property you're trying to purchase. They could use that number instead and factor that in as additional income. Okay. So again, we've talked about debt to income ratio. And as you get another mortgage, you need more income because you're going to hit that percentage pretty quick that they look at and say, yeah, we're not going to lend to you anymore. And so as you have rental income increase, then you're able to increase the amount of debt that you have proportionate to that. So the other way you can do this with mortgages is not purchase it as an investment property, right? You can purchase it as a primary residence. This is a house hacking strategy, and I'll detail that in a future video. But essentially, you can, if you're going to live in the home for 12 months, you intend to, then you can purchase it with a conventional mortgage, get a preferred interest rate, and even put down as little as 3% or less if you qualify, and live in the home. And then in 12 months, you can leave, and then you can use that and keep it and rent it out. Okay, that's fairly common. So I'll talk about house hacking in a future video, but you can do that. And then the only other thing I'll mention here with mortgages is on a conventional mortgage, you can actually purchase up to a 4-unit property. Okay, so you could get a single family home, a condo, a townhome, obviously, right? Single occupancy. Or you can get a duplex, triplex, or a fourplex. So if there's a property that has 4 units on it, or it's actually a fourplex, then you can actually go purchase that. You can occupy it, one of the units, and then rent out the other units that are there, and still get the same preferred interest rate and be able to put less down on the property overall. And then when, after 12 months, you could leave and fill in that unit, and then you'd have, that many units already rented out. So we'll talk about house hacking in a future video, but I want to help you understand what is available to you on the mortgage side from traditional lenders. Now, another very popular way to fund real estate investment is through hard money lenders. Okay, so these are people that are willing to lend you their money. It's very typically short term. Okay, I mean, they're fine with doing it longer term, but typically it's short term, and they charge very high interest rates. They could charge 8, 10, 15, 18%. It just really depends on who you go to and what it is. And as we talked about interest rates and how banks determine interest rates for you on credit cards or mortgages or auto loans. They look at risk, right? And what is the risk? And to be rewarded for that risk, we have to charge a higher interest rate. If you're very low risk, then they can give you a lower interest rate. So hard money lenders work the same way. They're going to lend you money that may not even have any collateral. They're going to lend you money, and you're going to say, hey, I'm going to go buy an investment property, and I'm going to fix it up and flip it, and then I'll pay you back. They're obviously going to command higher interest rates. It's just the way that it is. So there's hard money lenders out there that make a business of this, and you can go get money from them. It's what many people do when they need to purchase a home in cash. They go to an auction, right? They have this amount pre-approved from a hard money lender, and they can get cash very, very quickly, okay? They don't need to appraise a property. They're not basing it on that. It's just, hey, we're going to lend you this money, and it's due back in 60 days or 90 days and 15% interest rate, okay? So if you're thinking about purchasing a property and how to use this is not a long-term solution, but it is a way to get into the property. So you might, for example, purchase a property if you're going to buy and hold, okay? To be able to win that, right? Maybe you're at an auction, maybe it's a short sale, whatever it is, you want your offer accepted. And so you want to go in with a cash offer. You can borrow hard money, purchase the property, and then you can refinance it with a traditional lender. Okay, so you refinance, right? That takes however many days to close on a mortgage, like 30 days typically. And then they will pay it off essentially, and then you pay off the hard money loan. So it costs you 15% interest on that loan, but you were able to get the property, refinance to traditional financing, like through a mortgage, then you're good to go, right? That's a long-term solution. Another way, right, is through fixing and flipping, right? If you are trying to purchase the property, you might get enough money to purchase it and extra money to renovate it. So you need a certain amount to purchase it, certain amount to renovate. You go in, you do that in 30 or 60 or 90 days, and you flip the home, you sell it, hopefully for a profit, you pay back the hard money lender, and then you are left with a sum. So these are all ways to use other people's money to get properties and then make money doing it, whether it's through the business or through investment into more traditional financing that's more feasible, right? Lower interest rates and all that. And then the other way is to get people with money to partner together. Okay, so let's say you say, okay, I don't have capital, but I have time and I have some expertise. I know I can find a good property that would be a good investment. I just don't have any money. Well, pair up with somebody that does have money, but doesn't have the expertise or time to go find a property, right? An investor that says, I want to invest in real estate, but I don't know the first thing about it. I don't have any time to do it. I don't have any desire to try. I just want to get my money working, right? That's a perfect fit. So if you have the skill, the expertise, the time to make it work, present the deal and say, hey, let's partner, right? Whatever the split is, 50-50. I'm the sweat equity partner. You're the capital partner. We come together, we purchase the property, and off we go. Okay. That could be for as a business, right? Fixing and flipping. It could be long-term buy and hold, whatever it is. And then you split the cash flow. Okay. So that is another great option. You can also do this on a bigger scale, right? If you wanted to do a fund and you want to get a bigger property, you want to get a commercial property, right? A 20-unit apartment complex, you can pool people's money. And essentially all you're doing is you're creating a syndication, right? Like we talked about before. You're putting in the time, you're getting the money. Now you have to have a good story. You have to have the experience, right? Investors have to be able to rely on you. So you might need some experience to build up to that level, but there's no saying you can't scale to that level, okay? And that's where we get to investors. Investors are people you say, hey, I've got a track record. I've done this before this many times. This is the deal. This is how the numbers work out. And I'm ready to go. And they can invest and go from there. So that could be in any type of entity, a syndication or a fund or whatever. Generally, they're gonna do their due diligence and make sure you know what you're doing, but it's definitely possible. So that is how you can finance real estate. It's a lot easier than you would think. And again, if you put yourself into the network, change your mindset. It's generally a scarcity mindset around money. There is a lot of money out there. There is a lot, and there are so many investors that have a ton of money that they are waiting to put to work, and they don't have time to go do these things. Well, you can be the one that has time to do it. Okay, so we have to change the mindset around money, put in the work, and you can create an amazing investment portfolio without using any of your own money. Okay, I want that point to be crystal clear. Okay, now there are a lot of other strategies and things like that that go in more in depth. There's a lot of great resources out there where you can dive into it. People that actually do this on a day-to-day basis. This is just to give you an idea and a primer again, so that you can understand which route you might want to go and then start researching and dive in deep and learn everything you can in that area. All right, that wraps up for this video. See you guys in the next one.
Think bigger, work smarter.